Hello learner and welcome to the Financial Management course. My name is Matrika Prasad Sharma, your course coordinator for Financial Management course. In today's session, I will be guiding into the topic Sources of Finance. I am excited to take you to this journey and help you to build a very strong understanding on sources of finance. Imagine you are a business owner looking to expand your operations. You need additional funding but are unsure whether to take a loan, issue equity, or explore alternative sources. How would you assess the different sources of finance available, and how would you determine which option best meets the specific funding needs of your business? At the end of this topic, you will be able to estimate the various sources of finance as per the need of the firm's fund requirement.
Sources of finance are critical for businesses and individuals to support operations, expansion, or investments. Common sources include equity financing, where owners give up part of the business for capital; debt financing, such as loans or bonds, which must be repaid with interest; and retained earnings, which use profits to fund growth. Each source has its advantages and challenges, such as control implications with equity, interest payments with debt, and limited flexibility with retained earnings. Choosing the right source depends on the firm's needs, risk appetite, and long-term financial goals. Identifying various sources of finance is essential for businesses to meet their financial needs. It involves exploring different funding options like equity, debt, or internal funds, depending on the firm's goals and circumstances. Ensuring the organization has adequate resources is crucial to maintaining smooth operations, meeting obligations, and achieving growth. The funds must be raised according to the firm's specific requirements, considering factors like the amount needed, the purpose of funding, and the time frame. A well-planned approach to sourcing finance ensures long-term stability and the effective management of resources. Sources of finance can be categorized based on different criteria to suit the needs of a business. First is based on time frame. So this refers to the duration for which the funds are required, such as short term, which is less than a year, medium term, which is 1 to 5 years, and long term, which is more than 5 years. So these are varied financing options. Second is based on ownership. This involves the source of funds based on whether the capital is raised through equity, which is ownership stakes, or debt, which is borrowed funds, each having different implications for control and repayment. Third is based on national and international finance. So this refers to whether the funds are sourced domestically within a country or internationally, considering factors like currency, regulations, and global market opportunities. Sources of finance can be classified based on the time frame for which the funds are required. First is short term. These funds are required for a brief period, typically less than a year. Short term financing is often used to cover day-to-day operational expenses such as inventory, wages, or supplier payments. Examples include bank overdrafts, trade credit, or short-term loans. Medium term. Funds required for a period ranging from 1 to 5 years. This type of financing is often used for purchasing equipment or expanding operations. 4. Sources include term loans or leases. Fifth is long term. These funds are needed for more than 5 years, often for significant investments such as infrastructure, research, or business expansion. And the sixth one is long-term financing options, including equity capital, long-term loans, and bonds. Sources of funds based on the time frame required. Short term. Sources like trade credit, bank overdrafts, and short-term loans are used for day-to-day operations. These funds are typically repaid within a year and help manage working capital needs such as covering inventory or supplier payments. Medium term. Term loans, hire purchases, and leasing options provide financing for 1 to 5 years. These are often used for intermediate investments or business expansions such as purchasing equipment or upgrading facilities. Long term. Equity financing, long-term loans, and venture capital are used for significant investments such as infrastructure or major growth initiatives. These funds are typically repaid over a period longer than 5 years, supporting large-scale strategic projects. The two main categories of financing based on ownership are: number 1, owner's fund. This refers to the capital invested by the owners or shareholders of a business. It includes equity capital, retained earnings, and any other funds contributed by the owners. The key characteristics of owners' funds is that the business does not have to repay this capital, and it represents ownership in the company, giving the investors a share of the profits. Borrowed funds. Borrowed funds refer to capital raised through external sources such as loans, bonds, or credit. This type of financing requires repayment over time, usually with interest. Borrowed funds do not confer ownership in the business, but lenders or creditors expect to receive their principal amount plus interest according to the agreed terms. The two main sources of funds based on ownership: owners' funds. These include equity shares, retained earnings, preferred shares, venture capital, and angel investment. The key characteristics are that they represent ownership stakes in the business, providing permanent capital and profit-sharing opportunities. However, this form of financing tends to be more costly due to profit sharing and the lack of repayment obligations. Borrowed funds. This includes bank loans, debentures, bonds, commercial paper, trade credit, leasing, and factoring. These funds must be repaid with interest but do not dilute ownership. The advantage include tax deductible interest, though they come with a financial obligation to repay. Based on national finance, businesses can access funding from various domestic sources. Domestic banks. Businesses often obtain loans or lines of credit from domestic banks, which offer flexible terms based on the company's financial health. Government programs. Government provide funding through grants, subsidies, or low-interest loans to encourage business growth, innovation, or job creation, especially in strategic sectors. Third is stock market. Companies can raise capital by issuing shares to the public, allowing them to tap into investment from a large pool of investors in national markets. And the last one is private investors, creditors, and suppliers. So this includes personal or business investors, suppliers offering trade credit, and other private entities willing to provide financing based on business relationships. Each of these sources caters to different needs such as operational expenses, expansions, or innovation projects. So based on the international finance, businesses can explore global source of fundings. First is FDI, foreign direct investment. This involves foreign companies investing directly in local businesses, providing capital for expansion and operations. Multinational banks. Large global banks offer financing options to businesses, enabling them to access international loans, credit, and investment services. Third is international capital markets. Businesses can raise funds by issuing securities, which is stocks or bonds, on international stock exchanges, attracting global investors. Fourth is Euro issue, ADR, and GDR, which is American Depository Receipts, which is often termed as ADR, and Global Depository Receipts, which is often termed as GDR. Allow companies to list their shares on foreign exchanges, attracting international investment. These sources provide businesses access to global capital for growth and expansion.
So dear learners, in this topic we have learnt finance is classified into short-term, medium-term, and long-term based on the duration for which funds are required. Finance is categorized into owners' funds and borrowed funds, each with different implications for control and repayment. Finance can be sourced from national options like government programs, domestic banks, stock markets, and private investors, or international sources like multinational banks, FDI, international capital markets, and Euro issues, ADR and GDR. That's all for today. Thank you and happy learning.